So, good morning, ladies and gentlemen, dear colleagues, and a warm welcome to the second day of our Investment Management Forum. Let me start by saying that I hope you enjoyed yesterday's discussion as much as I did. I had a bit of difficulty to connect at the beginning, apologize for that, but I finally managed to join and I can assure you that I enjoyed it a lot. So thanks again to our keynote speakers and panelists for their high quality contributions and candid remarks. Definitely a lot of food for thought to all of us. The program we have prepared for you today looks no less exciting. This morning, we will be listening to a panel discussion on one of the hot topics of the day, ESG investing, one we already discussed a lot yesterday, with a particular focus on the importance of improving ESG data disclosures to unleash the full capacity of sustainable finance. Equally topical and important will be the subject of our second panel of the day, where prominent regulators will tell us about the first lessons learned from the COVID-19 pandemic, its impact on financial market and our industry, and actions they have taken in response to this, realizing, of course, that we are still in the midst of the sanitary crisis in many parts of the world, especially in Europe, and it's also too early to draw final conclusions. Then this afternoon, we will turn to another part of the world that has been the center for a lot of media attention over the last few days, the United States. So don't worry, we won't be commenting on the election. So starting with a fireside chat interview with Paul Stevens, a highly respected and authoritative voice for the US mutual fund industry, a longtime friend of EFAMA, and until very recently, president and CEO of ICI. Paul will share with us his views and wisdom on some of the key challenges that asset managers are confronted with on both sides of the Atlantic. And we will conclude with an overview of some of the hot topics and trends in US regulatory developments during a workshop hosted by our associate member, Descartes. But to start with, we are delighted to welcome once again Stephen Maijoor as keynote speaker for our annual conference. Since he was elected chair of ESMA almost a decade ago, Stephen, as you know, has been a regular speaker at our conference, and we are immensely grateful to him for that. He certainly needs no introduction to this audience, but before leaving him the floor, I would like, on behalf, I believe, of the entire asset management community, to thank you, Stephen, for having been such an indefatigable chairman over your 2 mandates, for building the strong and highly reputable institution that ESMA has become, and for being a supportive but also a demanding partner of the asset management industry, often forcing us to hold up a mirror and for helping us navigate through a financial crisis and a global pandemic. No doubt we have had a constructive debate with you on ESMA since inceptions, and we sincerely hope the dialogue will continue for the years to come. Stephen has kindly accepted to take some questions from the audience at the end of his speech, so please do not hesitate to send us your questions using the chat functions available on your screen. Now over to you, Stephen.
Thank you, Nicolas, for these kind words. Very good to be able to participate again in this important EFAMA event. Obviously, we would all have preferred to meet each other physically in Brussels. Always good to, of course, talk in Brussels and also meet people more informally. At the same time, I think we have been able, and I think that is probably one of the positive things of this crisis, is that we're able to do these things also on a remote basis. And let me also underline the point you made about the importance of the communication, the feedback, the interaction we have had between the asset management industry and ESMA, and also between EFAMA and ESMA. Needless to say that is very important for a well-functioning regulatory system, is that we have these interactions. And so many thanks for the cooperation in the past years. Ladies and gentlemen, I would like to take the opportunity to share some thoughts on the events that occurred since my address to you last year, and was mentioned already by Nicolas, quite extreme events earlier this year. These events have far-reaching consequences on our daily lives, but also a substantive impact on the financial sector, and more specifically on asset managers and investment funds. Last year, I focused my contribution on financial stability and investor protection, particularly on liquidity issues. This was inspired by events that occurred last year and pointed at liquidity risks in UCITS. As I already mentioned then, liquidity has been a key concern for a long time in asset management. Hence, there is nothing new on the topic as such, but the unprecedented events at the beginning of 2020 are of a magnitude which deserves some reflection on how funds reacted, especially in the context of the ongoing debate on the resilience of the non-banking sector in the EU. Notwithstanding the fact that this year I will touch on similar issues to those that I discussed last year, in light of the recent events, there should be little risk of repeating myself. Today, 9 months after the beginning of the COVID-19 outbreak impacting financial markets, I think it's time that we take stock of its impact on investment funds. In my address, I will share some of our findings on how investment funds have managed their liquidity in times of severe market stress. I will give my thoughts on the shortcomings the crisis has revealed and how managers, regulators, and legislators could possibly address them in view of further increasing the resilience of the EU fund management sector. From mid-February, the COVID-19 related events resulted in severe market stress, including for investment funds. This is an issue that we should take seriously in the EU because of the consequences for financial stability and also for investor protection. I would like to emphasize the latter point. When funds face stress and liquidity issues, it is not only the financial system which may be affected because of the systemic relevance of the affected funds and their interconnectedness with the financial sector, but also individual investors may be heavily impacted. Their redemptions may be halted or limited, or the proceeds substantially affected by the application of measures that are necessary to ensure the fair treatment of all investors, so both those that are redeeming and those that are remaining in the fund. Redemption fees, anti-dilution levies, or swing pricing are typical examples of measures that may have to be introduced or adapted in extraordinary circumstances to ensure the fair treatment of all of the investors in a fund. These measures may appear as a bitter remedy for individual investors, but they can be justified to ensure the fair treatment of the other investors and safeguard financial stability more broadly. Mindful of the importance of these aspects, ESMA has reinforced its coordination role, and since last March, we have organized frequent exchanges with national competent authorities, or NCAs, to discuss market developments and supervisory risks linked to the COVID-19 crisis, focusing in particular on liquidity issues in asset management. We fostered exchanges among NCAs on the use of liquidity management tools, or LMTs, which play an important role in helping asset managers to deal with tense market situations. In addition, since end March, ESMA collects data on the use of extraordinary LMTs, such as the suspension of redemptions, redemptions in kind, side pockets, and activation of gates, but also the adaptation of LMTs which are commonly used. For instance, this concerns the modification of the swing factor mechanism, increase in redemption fees, or change in the dealing frequency of the fund. Overall, there was an increased use of exceptional LMTs, but still modest in absolute value. For instance, only 0.2% of assets under management within the EU were temporarily suspended by the end of March 2020. Based on the information reported by NCAs, the great majority of suspensions were activated to protect investors' best interest in a context of valuation uncertainty. And I will expand on valuation uncertainty later in my speech. I believe that promoting prompt exchanges among NCAs at EU level on what is happening at national level in periods of market stress is crucial in a sector where cross-border activities are the norm. Indeed, what happens in one jurisdiction may well have consequences for investors in other jurisdictions and financial stability at EU level. Moreover, these exchanges are fully in line with the general ESMA mandate to coordinate NCAs, and I quote, in particular in situations where adverse developments could potentially jeopardize the orderly functioning and integrity of financial markets or the stability of the financial system in the Union. And I quote here from our founding regulation. Yet, one could argue that fostering exchanges is not enough in situations with cross-border implications, in particular where these relate to financial stability. There are often situations where an investment fund is established in one member state, but its manager is based in another, and it might not be clear which NCA is responsible for supervising the suspension of redemption and subscriptions or the circumstances justifying an authority to intervene with suspension powers. This is the reason why, more generally, we recently expressed support for the idea that when there are cross-border financial stability implications, the respective NCA's role should be specified in relation to their powers to mandate suspensions, and there would be merit in granting ESMA a clear coordination role in these cases. Coming back to our COVID-19 related activities, the ESRB recommendation published last May deserve a special mention. This called for a supervisory exercise across the EU regarding investment funds that have significant exposures to corporate debt and real estate. The objective of this recommendation was to prompt supervisory work aimed at assessing the preparedness of these funds for potential future redemption and valuation shocks. ESMA and NCAs, therefore, launched a data collection exercise during the summer with a focus on the crisis events between February and March of this year. This exercise, which we just concluded with the delivery of an ESMA report to the ESRB, was based on a common methodology developed at ESMA level, consisting of the analysis of the reaction of selected investment funds to the recent events and simulations of stress scenarios to assess their resilience in case of additional future stress events. The ESMA report, which is published today, shows that overall the investment funds under review managed to maintain adequately their activities when they faced redemption pressures and episodes of valuation uncertainty in the first quarter of 2020. Indeed, only 0.4% of these funds, and I repeat that because it's a small number, suspended their subscriptions and redemptions. However, an immediate and obvious finding is that this figure is twice as high as the one that I mentioned earlier for all funds at EU level. This difference can be explained by the fact that the analyzed sample included only funds investing in less liquid assets or assets for which liquidity may recede in times of crisis. In addition, these results need to be interpreted with caution for many reasons. First, the stress in the market was of a short duration because of the swift action by central banks and governments. Secondly, some of these funds had potential deficiencies in their liquidity risk management or valuation processes under stressed market conditions. For example, the analysis identified funds offering a high redemption frequency without notice period or LMTs, while investing in illiquid assets or assets that may become illiquid during a period of market stress. Two other takeaways are worth mentioning. First, concerns around the valuation of portfolio assets have emerged, especially for real estate funds, for which the crisis could have a more significant impact over the longer term. Second, it was confirmed that the availability and use of LMTs vary considerably across the EU, depending on national rules and supervisory actions to foster their use. Against this background, ESMA identified 5 priority areas to further enhance the preparedness of corporate debt and real estate funds to potential future redemption and valuation shocks. 3 of them relate to key provisions that management companies should strictly observe. These provisions concern, first of all, the requirement to align the fund's investment strategy with the redemption policy. Secondly, the quality of the liquidity risk assessment. And thirdly and finally, valuation processes in a context of valuation uncertainty. In these areas, ESMA urges asset managers to step up their efforts to ensure that the relevant requirements are adequately complied with. We also asked NCAs to pursue the ongoing monitoring of compliance with these rules. For instance, misalignments between the liquidity profile of funds investments and their redemption policies should be corrected in a timely manner. The monitoring activities by NCAs should focus especially on those funds analyzed in this exercise, which should correct potential breaches of the requirements without delay. Another priority area is the increase of the availability and use of liquidity management tools, which should be taken forward in the context of the AFMD review. As you will recall, both the ESRB and ESMA have recommended already earlier the adoption of harmonized rules regarding LMTs in the UCITS and AFMD frameworks to ensure greater protection of investor and the consistent use of these tools across the EU. Pending this legislative harmonization at EU level, some progress may already be achieved at national level on the availability and use of LMTs in close coordination and cooperation with ESMA and NCAs. The last priority area relates to the enhancement of the fund liquidity profile reporting under the AFMD to support a risk-based supervision of liquidity risks. Similar provisions should be introduced under the UCITS framework, where ESMA has also expressed support for the introduction of a reporting regime like the one under the AFMD. As you can see, this has been a very fruitful exercise that should lead to concrete follow-up steps, most immediately on the side of managers whose funds failed the relevant stress simulations, and more generally, those managers managing funds that showed deficiencies. This should be completed by appropriate supervisory action by the relevant NCAs across the EU. The ultimate objective is to enhance the preparedness of the fund industry in a context where ESMA has raised the awareness about the fragile current market environment and the decoupling of financial market performance and underlying economic activities. These priority areas also address, to some extent, the concerns expressed by the ESRB in relation to financial stability. ESMA considers that reducing the liquidity and valuation risks at the level of the investment fund sector would reduce the risk and the impact of collective selling by funds on the financial system, and therefore the likelihood of a systemic event. I would now like to focus on specific deficiencies that materialized during the COVID-19 crisis in the asset management sector and which deserve specific attention by regulators. In March 2020, as volatility surged and investors rushed to raise cash, some segments of the EU money market fund industry were subject to acute stress, while MMFs exposed to public debt, so-called CNAFs, recorded large inflows as a result of the flight to safety. LVNAF MMFs and VNAF MMFs experienced challenges on both sides of their balance sheet. On the liability side, investor redemptions peaked in the second part of March, with outflows totaling 20% for LVNAVs MMFs and more than 10% for VNAVs in some EU countries. On the asset side, many markets froze, with a large decline in issuance and spike in yields as banks and other participants were reluctant to buy commercial paper or certificate of deposits. For LVNAVs, this situation created the following challenges. To meet redemptions, managers had to sell assets. On the other hand, selling liquid assets would deplete their weekly liquid assets, and if the proportion of weekly liquid assets falls below 30% of their net asset value, MMFs must consider implementing redemption fees or gates. On the other hand, MMFs could only sell other assets at discount prices, resulting in mark-to-market losses and deviation from their stable NAV, which in some cases reached 18 basis points, being 2 basis points below the well-known 20 basis points limit that requires the conversion of the LVNAV to a VNAV. Although requirements are different for VNAV and MMFs, such funds also experience severe stress due to redemptions and lack of liquidity on the asset side, as VNAV MMFs and LVNAVs tend to be exposed to the same asset classes. Central bank interventions in the US and in the euro area through direct purchases of commercial paper or funding facilities restored confidence in March, with a reduction in outflows and an improvement in liquidity. Overall, no EU MMF had to use gates or fees to suspend redemptions. Nevertheless, these events call for further reflection on the remaining vulnerabilities in the MMF sector. I would like to recall that in the context of the Level 2 and Level 3 measures under the MMF regulation, which has been adopted as a response to the 2008 crisis events faced by MMFs, ESMA has already developed in recent years a regulatory framework that will help in monitoring closely the risks related to MMFs in the EU at all times. Managers of MMFs now need to develop common stress test scenarios which are standardized and specified by ESMA in the guidelines on MMF stress tests that we update every year to take into account market developments. More importantly, as from this year, managers of MMFs need to report the results of these stress test scenarios to their NCAs, which in turn will have to report the results to ESMA. Going forward, the centralization of the results of the stress test will significantly improve the close monitoring of MMFs in the EU. However, looking at March events, the questions to be asked is the following. Is the current MMF regulatory framework sufficiently robust to prevent future similar crisis episodes? As I said earlier, the events of March 2020 have shown that despite regulatory reforms, vulnerabilities remain in the MMF sector. It is crucial to analyze in detail the reasons for these vulnerabilities in order to consider the potential policy reforms. And let me give you a brief overview of the issues to explore, noting that we're still at very early stages. First, there are still structural issues that need to be addressed. Indeed, the liquidity of money markets is quite low, even in normal times, which implies that during periods of stress, MMFs struggle to sell some of their holdings. Improving the liquidity of such markets could be an option to improve the resilience of MMFs. And second, and to be honest, I think further reforms of MMFs are needed. However, at this stage, there is no common view on which changes should be contemplated, and we need to assess the various policy options very carefully. The acute stress faced especially by LVNAVs requires to further look into the role of net asset value collars or the relationship between weekly asset levels and fees and gates. For example, should further guidance on the use of liquidity buffers be explored? Should we reconsider the relationship between liquidity requirements and the use of fees and gates? In that context, the upcoming review of the MMF regulation can provide a timely opportunity to revisit the MMF framework to make sure that MMFs continue to play their role as key intermediaries in the EU financial system while improving at the same time their resilience. Finally, and more generally, I reiterate my support to the development of a macroprudential framework for investment funds. The growth of the fund sector plays a positive role in the financial system, for example, by supporting the debt issuance market and the financing of the economy. But it also implies a more interconnected EU capital markets. A macroprudential framework is therefore a key element in making them stronger. Most importantly, an extension of the macroprudential framework to non-banking institutions will not need to be built from scratch. There are some existing foundations. In fact, important conceptual work is already underway for some time. At global level, the FSB and IOSCO will continue to provide financial stability recommendations relevant to the non-banking sector, including market infrastructures, asset management, and securities finance and transactions. ESMA is part to these discussions through our participation in the Standing Committee on Asset Management of Vulnerabilities of the FSB and in the Financial Stability Engagement Group of IOSCO. These groups will build on the earlier work done by IOSCO in the area of liquidity and leverage for funds and will consider carefully the lessons learned during the market turmoil this spring. These lessons will be discussed later this month at the G20 summit. At the EU level, the work of ESMA and the ECB support that evolution. The recent ECB recommendation on liquidity risks in funds that I covered earlier is one of the many initiatives carried out over the last few years. Another important one is the 2017 ECB recommendation on leverage and liquidity in investment funds. Action taken in response to the latter include the publication of guidelines on liquidity stress testing in September 2019 and the ongoing work for the development of ESMA's guidelines on leverage limits under the AFMD. Therefore, ESMA expresses its full support for further initiatives to develop a macroprudential toolkit for investment funds, which could be taken forward by the ECB in cooperation with ESMA and the NCAs. Ladies and gentlemen, let me now conclude with these remarks. It is not possible to predict how financial markets will develop in the months to come, but we can already draw some interesting conclusions from the past 9 months. First, the use of LMTs by management companies of open-ended funds, where available, was overall satisfactory and helped preserve the interest of investors, but there's still room for increasing the availability of these tools and supervisory convergence in the field of liquidity management. Secondly, asset managers need to step up their efforts to ensure the liquidity of their funds is adequately managed and that they are prepared for future shocks. This is especially relevant for funds exposed to less liquid assets. This needs to be coupled with ongoing supervisory efforts to ensure compliance with the rules and ultimately achieve financial stability and better investor protection. ESMA is ready to continue its efforts to coordinate NCA's activities in this area. Third and finally, we need to look forward to the upcoming legislative reviews. In these, we must ensure that the lessons learned from the COVID-19 crisis are taken into consideration and that any identified weaknesses are addressed promptly in the best interest of the EU asset management industry and the investors whose assets it manages. Thank you very much for your attention. I think you're muted, Tanguy.
Thank you, Stephen. I was thanking you for your very insightful views, as always, and also for all the work you did over the summer concerning this data collection exercise. I think this is very timely, and we will, of course, look into it with much attention. We have received quite a few questions. Let me start by the first two regarding liquidity. The first one relates to property funds. So let me read it out to you, Stephen. Should the use of redemption notices be made mandatory for open-ended property funds? So the use of redemption notices, should they be made mandatory? And the second question relates to the corporate debt market. Do you see a need to improve liquidity in the secondary market? So not talking about the liquidity of the funds, but more of the market itself.
Well, maybe start with the second issue first. So, as you know, under MiFID II, we have tried to improve the liquidity of corporate debt markets. I must say, and many of you will recollect, and that we were in favor of a more bold steps regarding transparency. And obviously, we're very much aware that you always need to balance very well and need to be very targeted in which parts of the corporate debt markets you want to have transparency, because indeed, if it's inherently illiquid, then even further transparency might harm liquidity. And we have argued in the past is that if you have the right balance between requiring, in some cases, more transparency in the corporate debt market, that it would support more liquidity, that it would support transparency. In our view, the Commission and the co-legislators were not as bold as we would have preferred. We have made that point again now in the review of MiFID II, and I think we can make steps indeed in improving the secondary market by better calibrating transparency. And let's hope that the advice that we provided in the context of the MiFID II review is that will be helpful in that respect. I think on the specific requirements around notices for real estate, we have not taken that position. I think we are generally not in favor of saying in a specific case a specific liquidity management should be applied or should be required. We have taken the line so far that what is important is to make sure that the liquidity management tools are better available across the EU. You know that there's wide variation across the EU. Some countries being many tools available, other ones very limitedly available. And so we think the next step should be here, make sure that they are that they're more available across the EU and that they are consistently available. And ultimately, we have always emphasized the importance of judgment and taking a case-by-case assessment, what kind of liquidity management tool is appropriate for which kind of fund, for the characteristic of their investment portfolio. That is the approach that we take here.
Thank you, Stephen. You mentioned liquidity management tools. We have one question, and you just, I guess, answered it in part. What is it that ESMA can do to ensure convergence in terms of availability and use of liquidity management tools? We know that you sent this letter to Commissioner Dombrovskis asking to the Commission to take steps. What is it that ESMA can do to make sure that those tools are available across jurisdictions?
So what we so first of all, I think first of all, it is a legislative issue, and so that is the reason for the ESMA making this point. We are making this point, and we would really hope that the Commission and the co-legislators would progress on this. The reality is, of course, is that also on the use of liquidity management tools, it is important that we coordinate, exchange experiences between regulators and try to get to a more common understanding. What we always emphasize, of course, that it's first and foremost a decision of the funds themselves. We don't want to go to a model where basically the application of a liquidity management tool is basically instructed from the regulator. It has recently happened, but we think generally this is a responsibility of the managers themselves. At the same time, what we have seen during the COVID-19 crisis, that in some cases there was a stigma to use certain liquidity management tools because it was, managers were reluctant to use that, and it was important there to exchange experiences between regulators. To what extent we can share experiences, and that in some cases it might indeed be beneficial to use them, and it shouldn't be seen, let's say, necessarily as a weakness of a fund, because ultimately this is also around ensuring the fair treatment of those investors that step out earlier and those remaining. And so we see a coordination role, giving certain messages to the industry about the use of liquidity management tools. At the same time, we also think it's important to realize that the first responsibility for using them is by managers themselves.
Thank you, Stephen. Another question on data and reporting. Do you see potential for improving data sharing between central banks, or the ECB, and ESMA and the ESRB, or the NCAs?
Well, I think where we have made a big step in terms of evidence collection is during this COVID-19 crisis, and I must say more broadly and more generally, this crisis in terms of data exchange, collective risk assessment, was so different, let's say, from the sovereign debt crisis and from the financial crisis. The amount of intelligence that we had as a board on a very frequent basis, and I think that during the top of the crisis, in some of the weeks in March, I think we even had collective calls of all board members, I think maybe even 3 times a week. And so the amount of intelligence, the understanding of what was happening and what was going on in the financial market was so much better than in the previous sovereign debt crisis or the financial crisis, not only relating to asset management. For example, the information that we had on trading venues, on CCPs, margin exchange, very extensive, and without being complacent. I think we all can, and I know that your membership sometimes complains about the costs of reporting. I can also say we use it, we have used it, and we continue to use it to understand where the stress is in the financial markets. And so overall information exchange in the financial markets has improved very much. The amount of information that we had on outflows of funds across the EU was so much better than the previous crisis. The use of liquidity management tools so much better than the previous crisis. And for example, that was also the reason I was able to report in the speech on the actual, what percentage of the net asset values was, let's say, subject to suspension. What we have shared, and that you will see from the report here today, is the report that we published today is obviously shared with the ECB. It is a data-driven, evidence-driven report. And in that sense, I think there is a good opportunity already to share our evidence. We are very closely involved with the stability authorities. We fully understand that stability authorities are looking into the asset management sector. And so the approach we're taking here as securities regulators, as ESMA, together with the ECB, but also as a global level, is to share our experiences, share the evidence, because we fully understand that considering their mandate, we need to be transparent about the risk and not be complacent about the risks in the non-banking sector, particularly in asset management.
Thank you. I can tell you that we very much value all the papers, all the working papers that come out of ESMA. We can see that you make full use of all the data that we report to you in the NCA. So we do have a kind of immediate interest in you making full use of these data. I have a question which is not related to what you talked about, which has to do with delegation and the letter you sent to Commissioner Dombrovskis in July. And the question is, why is it that ESMA is calling for possible level one changes concerning delegation of portfolio management? And why is it that you cannot make full use of all the tools you have at your disposal to ensure supervisory convergence?
Also, a couple of comments on this, and I know it's a sensitive topic where we are, I'm not a central banker in terms of my reflection of my word, what it says about monetary policy, but seems nearly that we have our own little issue with that in delegation, and very careful listening and reading the letters that we sent on this matter. So maybe, and if there's any other clarity, happy to further clarify. So first of all, the letter is not a recommendation or an attempt to change the delegation model as envisaged in the AFMD. It is about clarification. And maybe to describe the bigger picture, we are on the one hand very much in favor of delegation. We know that delegation improves efficiency, gives access to expertise that would otherwise not be available. It can result in benefits of economies of scale, and so it's important to delegation is part of the modern business model, and we fully recognize that. At the same time, it is also that ultimately regulation and supervision is done at a jurisdictional level, and that is where the hook for our supervision is. And so it's important that when there is delegation, that is done in an appropriate way. One of the issues that we observed, and we see the letter as very much in line with the opinions that we have expressed on Brexit a few years earlier. We see it as let's say, as an implementation of the opinions that we did on Brexit a few years earlier, is what we see across the member states is a variation in the interpretation of the AFMD regarding delegation. And for example, and if I'm correct in terms of the precise legal wording, it says is that the activities that are delegated to outside of the EU should not exceed with a substantial margin the level of activity, let's say, that is in the EU. And the question is, how do you define that substantial margin? That exceeding by a substantial margin, and that is an area where we're asking for more clarification from the Commission. And the question is, can that be done for example, in the form of describing certain functions that should remain let's say, in the EU? Is it in terms of the size of the asset management activities? But we need to have a better common understanding of these type of concepts to make sure that we're consistent across the EU. In all fairness, we know that on the one hand, and that's the point that I emphasized, is that on the one hand is that delegation, it can be positive, it can be beneficial, efficiency, benefits to economies of scale, but we also know that it can be used, there's the risk of circumventing regulation and supervision, because obviously the application of the AFMD requirements to the delegated activities is much more indirect, is not directly subject to the AFMD, and therefore we also see a risk of circumvention of the rules.
Thank you. I have two more questions, if I may, Stephen. The first one is, let me read it out. Thanks for the very interesting speech that focused on liquidity issues. What about the other priorities of ESMA in 2021 relating to the asset management? So this is more for those who have not read your work program for 2021. So what is in store for us next year?
As you know, you benefit from a lot of attention from us, Tanguy, to say it in that way. Maybe first, and I know this is not now on our program, but it's more at the side of the Commission. But I think we are very much aligned there with the industry, but also with retail investors. It is important that we progress on PRIPS. And as you know, we have taken a decision on that. We have decided on that as boards earlier this year. I know that it didn't get the formal requirements across all three boards, but I would really hope that there's progress on that file, but I recognize it's not on our work program. What is on our work program and very relevant to you is obviously the work that we will be doing on cost and performance. We think that the asset management sector can play an important role and should play an important role in the Capital Markets Union. We have always made a point that retail investors should play a bigger role in the Capital Markets Union. There should more households in Europe should benefit from the capital markets, and obviously the asset management industry has a very important role there because the asset management industry can offer products where products are diversified, where they are less risky. At the same time, these products also need to be efficient. And so one of the issues that we will continue to focus on next year is issues around cost and performance of retail investment products. There will be also a dedicated common supervisory action in that area, but I would see it as a positive where ultimately there's also an opportunity for the asset management industry to grow and to play a bigger role in households in the EU.
Thank you, Stephen. And then the final question is a more personal one. I read it out to you. Next year, you will be leaving the chairmanship of ESMA after 2 eventful and successful mandates. Is there an achievement you are particularly proud of, and perhaps also a regret?
First of all, on what I'm particularly proud of is that I can remember well when I did my hearing in 2011 for the job, is that at that time you could feel the uncertainty in many people about, what are these authorities? What will this be? Will this become a part of the regulatory and supervisory system? And I feel very confident and very happy about that has disappeared. We are, the European supervisory authorities, ESMA, are a strong part of the regulatory supervisory system, and we have contributed, we have made tangible progress in removing barriers among member states, strengthening investor protection, strengthening stability. And so that is what I'm very, very proud about. Regrets, I must say, I'm already very long in the, being a regulator. To some extent, it's not the way we look at our jobs. We are used for not getting applause and to be relatively short on positive feedback. Regulators are typically getting in the spotlight when things go wrong. We're sometimes considered to be making life more difficult for industry. And so I think what is very important as a regulator is to have an optimistic nature. And so I must say I haven't thought about regrets about the past 10 years, Tanguy.
Thank you, Stephen. So thank you so much for your time, for your participation in this event, and also for the excellent dialogue we have always had with you and your staff. And, I think you can certainly be very proud of what you have achieved at the helm of ESMA. So, this is a compliment that EFAMA is giving you with pleasure. So again, thank you so much for your participation. We shall now
have a good day today at the conference. Have a good day. Bye-bye. Thank you very much.
So we will now have a short break before the ESG disclosures panel that starts at 10:25. In the meantime, we will conduct a little poll to introduce the panel discussion. We would be most grateful if you could answer the poll questions now. The poll will appear on the right side of your screen, just next to the chat under the poll tab. So again, please kindly take the time now to answer the questions, and we shall discuss your reactions with our ESG disclosures panel at 10:25. Thank you so much.